One of the most difficult things about dividend investing is knowing what to look for when choosing stocks to add to your portfolio, but in this video, I'm gonna make it real simple for you. There are 5 essential qualities that all of the best dividend stock investments have, and today we're gonna talk about them and how they can help you invest in the right companies to achieve more success on your investing journey. So without further ado, let's get into it. All right, what is going on, my friends? Ryan Williams here, back with another one. In case you're new to the channel, welcome aboard. Here we strictly talk about how to create passive income and reach financial freedom by investing in dividend stocks, which is something that I've been doing now for at least the last couple of years. I started documenting my investing journey here on YouTube back in October of 2020, knee-deep into the pandemic, and in that time, I've seen my portfolio grow from about $100 in annual dividend income to now bringing in over $1,650 every single year, which just blows my mind. And in that time, guys, I've definitely made some mistakes. You know, I'm not gonna lie, I've invested in some stocks that maybe I shouldn't have. I've sold out of some that I should have held on to, but most importantly, I've learned a lot and probably could have saved myself a fair amount of time and definitely some trouble if I would have paid more attention to the 5 essential qualities we're talking about today that all great dividend stock investments possess. Starting with the first one, which is a low payout ratio. And for those of you who have never heard of this term, the payout ratio is the percentage of earnings that a company pays to their shareholders in the form of dividends. And it's a very easy thing to calculate. It's a simple calculation. All you have to do is take the dividends per share paid by the company and divide that by the company's earnings per share. And as an example, guys, Target pays $3.60 per year in dividends, and they have an earnings per share of $10.60, which gives you a payout ratio of 33.96%, which is very low. And to give you guys a rule of thumb that you can use, a good payout ratio to look for really is anywhere below 60% for normal companies. And there's some exceptions there that we'll talk about in just a moment. But for the most part, below 60% seems to work. You don't want a super high payout ratio because it means the company is paying out a lot of their earnings to us in dividends, which is good for us shareholders in the short term, but could hinder the sustainability of the dividend if the company wants to continue growing it into the future. Now, there are some exceptions to this, guys. Certain types of companies like real estate investment trusts and business development companies are afforded certain tax benefits if they pay out 90% of their income to us as shareholders. So that's one of the requisites for those kind of companies. So you'll see higher payout ratios just from those inherently. And there are some other companies out there that tend to operate just fine with higher payout ratios. These are going to be lower growth companies, ones like Coca-Cola or Pepsi or Altria Group, all of which have very impressive dividend growth histories. So it seems to work just fine for them. Now, moving on to the second quality that you want to look for, this is a strong dividend growth history. And this is a very simple, straightforward one. Obviously, you're going to trust a company with a longer dividend growth history than one that, hasn't been able to grow their dividend at all. It's a really great indicator of a company's financial strength and resolve when they're able to continue paying and growing their dividend during certain tough times like recessions or even, pandemics, which we experienced not too long ago. Many companies, like a few of the ones we mentioned just a moment ago, the Coca-Colas, Pepsis, Altria Groups, continue to grow their dividend even through these turbulent times. And if you're looking for a rule of thumb here, really when it comes to dividend growth histories, it's the longer the better, okay? And with that, there's an elite list of companies we can look to that have really exceptional dividend growth history, starting with this first one, the Dividend Aristocrats. And those are companies with 25 years or more of consecutive dividend growth. And a few examples of these types of companies, a few Dividend Aristocrats are Realty Income, ticker symbol O, with 25 years of consecutive dividend growth. Aflac, ticker symbol AFL, which has 40 years of consecutive dividend growth. And Walmart, you guys all know Walmart, they have 48 years of consecutive dividend growth. Now, even more impressive are the Dividend Kings, which have at least 50 years of consecutive dividend growth. And these are going to be companies like Lowe's, ticker symbol LOW, which has 58 years of consecutive dividend growth, Coca-Cola, which has a dividend growth history of 59 consecutive years, and one of my favorites, Procter & Gamble, which has a whopping 65 years of consecutive dividend growth. Now, the third quality you'll absolutely want to look out for, this one's very important. This is steady revenue and earnings growth. You want to see the companies you're investing in continuing to perform well over time. And, every so often there's going to be a down quarter or a down year where maybe they don't do as much as sales or aren't as profitable as prior years. One of those every once in a while is totally fine, but overall you want to see both of these things trending up, the revenue and earnings per share. A few examples of companies with really strong revenue and earnings growth are going to be ones like Apple right here, ticker symbol AAPL, as you can see on the screen. Yeah, there's a couple down years here and there, but for the most part, this revenue chart is trending upwards, as is the earnings per share. And another example of a company with a really strong revenue and earnings growth is going to be Lowe's, which is just trending up and up and up. Now, moving on to the fourth quality that is possessed by all great investments. This is arguably one of the most, if not the most important thing to look out for. That is a durable competitive advantage, which is another term for that. We call it a moat. And this is essentially something about the particular business or the industry that it's in that will help the company in question, the business in question, stay protected from the competition. And this can come in several forms, guys. The first of which we'll talk about is things like proprietary technology. And a company that has a lot of this going on is 3M, ticker symbol MMM, who has over 118,000 patents with 4,000 more added every single year. One of the patents they have is the one for sticky notes or post-it notes. And no other companies out there are going to have it. The patent belongs to 3M. Another common durable competitive advantage that you can look out for, and this one is possessed by a lot of companies in the telecommunications sector. This is a high barrier to entry. Now, companies like AT&T or Verizon, obviously very big, important businesses, but it takes a lot of capital. It takes a lot of money to get a business like this built and off the ground just because of all of the infrastructure necessary that you need to build out to start a business like this. And so the high investment cost keeps a lot of competitors from entering this market space, allowing companies like AT&T and Verizon to dominate without much competition. And the third competitive advantage you'll come across, this is probably the one that we're all most familiar with, and that is a powerful brand name. And think of companies like Apple, like Starbucks, Coca-Cola, McDonald's, Pepsi. All of these different companies have a really strong brands. Some of them have been around for, centuries. Coca-Cola is an example. And one of the reasons they're able to pull this off is because they have that very strong, that high brand power. And what that does, it creates not only recognition, worldwide recognition. You can go anywhere in the world, they recognize the Coca-Cola logo. But it also creates customer loyalty and keeps people coming back. For better or for worse, people get attached and they're drawn to the brands that they know and love. And so it's a very powerful competitive advantage. Now, moving on to the fifth and final quality we'll be talking about today. This is a high dividend yield. And before we go any further, guys, there's a reason that we mentioned this one last. If you've checked the box on the first four qualities, a low payout ratio, a strong dividend growth history, strong revenue and earnings growth, a durable competitive advantage, if that's all there, a nice high dividend yield is the cherry on top. And as I'm sure you can imagine, a high dividend yield is obviously more preferable to a lower dividend yield because you're getting a higher return on your investment. But like I said, it's only a sweet addition if the other four criteria are met. And having said that, guys, what constitutes a high dividend yield? Well, I personally consider anything 4% or above to be super high. And there's some, really high yielders that far surpass that. But a few examples of some high yielding dividend stocks are going to be Realty Income, ticker symbol O, which has a 4.33% dividend yield. Verizon, which we talked about earlier, which has a 4.99% dividend yield. AT&T, which has a 5.24% dividend yield. Altria Group, which has a 6.65% dividend yield. Now we're really getting up there. And last but not least, Main Street Capital Corporation, which has a 6.75% dividend yield. And having said that, guys, don't just go out and look for stocks that only have a 4% dividend yield and above, because there's so much more to investing in dividend stocks than just trying to find the highest yield. There's a lot of bad high yielders out there. Don't just look for the highest yield. Don't fall for the yield traps.
Don't do it.
Now, with all of this said, if you guys are ready to add some dividend stocks to your portfolio, then check out this video right over here. In this one, I'm telling you about 3 of the cheapest, the best dividend stocks to buy this month in June, one of which we've talked about a few times already in this video. So click on this right over here and I'll see you in the next one.